a very warm welcome to all of you. I'm delighted to welcome all of you, and I'm really grateful to the CEPR that despite the pandemic, we can host the Adam Smith workshop this year. There were a very large number of submissions. This year we had 550 submissions, out of which we could include only 21 papers in the program. So that's an acceptance rate which is under 4%. And it is unfortunate that of the many excellent papers we received, we couldn't include all of them on the program. In order to accommodate a slightly larger number of program papers than we normally do, we decided to run the conference over 3 days. So each day the conference will run from 2 p.m. Central European time to 6 p.m. And during this 4-hour slot, we will see 4 papers presented. Each paper is allotted 1 hour, 25 minutes for the author, 20 minutes for the discussant, 10 minutes for questions from the audience, and then the last 5 minutes to transition from one paper to the next one. Each day, when you log on to Zoom, you'll be assigned into a room, either for asset pricing or for corporate finance, based on the preference you exhibited at the time of registration. You can switch between rooms at any point during the first 3 hours of each day. And then the last paper will be a joint session for asset pricing and corporate finance, and you will be automatically moved into the room for the joint session. We're going to have a new feature at the end of the day. At the end of the day, for each paper, we will have a breakout room, and people who want to chat about a particular paper can move into that room and chat with other interested people and the presenter and discussant if they are available to chat with you. Okay. And the last thing I want to say is a very big thank you to Mandy Chan and Gabriel Schachter from the CEPR, who really done all the work to make this a reasonably easy conference to manage. I very much hope that next year, when the conference is scheduled for INSEAD, we can meet in person and we don't have to rely on a distant meeting approach, which is the best that we could do for this year. So thank you all for being here. And the chair for the first day for the asset pricing part of the conference is going to be Hugues, and for corporate finance, it's going to be Johan Humbert.
So let's get started. Welcome back. So welcome to the first joint session in asset pricing and corporate finance. So the presenter today will be Baozhong Jiang. So Baozhong, you have 25 minutes. The screen is yours.
Thank you very much. Thanks a lot for including our paper in the program. It's a fantastic conference. This paper is joined with my accounting colleague Chantal and our PhD student Alan Zhang and Wei Jiang at Columbia University. And your comments are very welcome. So let me start by motivating our paper. We all know that a corporate disclosure provides very important information to the financial market that can communicate about the financial health, promote culture and brand, as well as providing information to all stakeholders. Prominent example is probably Warren Buffett's annual letters to shareholders, which have become classics. Here are some examples. And notably, those writings are intended for an audience like this, right? Like the annual shareholder meetings in Omaha. In other words, human readers. But recently, we have seen some kind of shift in the audience to corporate disclosure. especially to robots and algorithms. The reason is that the technology has advanced to such a point that machine learning and natural language processing has become widely available and has been applied so. For example, the volume of regulatory filings also make it inevitable for machine to process them. The SEC commissioner actually in a speech actually estimated Edgar has about 11 million filings by over 600 reporting entities. And there were more than 1.5 billion unique requests in 2016 alone. So, and the length of 10K has increased by 5 times over a period of about 10 years. So they, SEC also estimate about 85% of all the document visits are done by internet bots. So all this implies that machines are inevitable and being applied in document processing. Prior literature such as Huang and Kim has documented that it pays to write well. The writing style of your corporate disclosure actually matters for returns and so on. But now, when managers decide corporate disclosure, they also need to think about how to resonate with machine readers in addition to human readers. Now, what are the main research questions of our paper? So we want to study how public companies actually adjust the way they talk, given that they know machines are listening. There are several aspects of our question. First, whether the knowledge of AI reader base is connected to the effort to make their disclosure more machine friendly or more machine readable. And second, whether they actually actively change the contents or sentiment in their disclosure, right? Whether they change the sentiment and tone after the availability of new algorithms, for example, like Laurent McDonald sentiment dictionary become available to machines. And finally, we do another test outside the typical disclosure in the context of conference calls, whether managers like modify the emotional quality as assessed by machines. So our paper can be connected to several strands of literature. First of all, there's a large and growing literature on studying the SEC download of SEC filings. And also there's a very large literature using textual analysis and machine learning to analyze corporate disclosure and filings. But our paper differentiates from the above literature in that we study the other problem. Instead of trying to extract information or sentiment from corporate filings using machine learning methods, we are studying how companies might respond to the machine learning efforts in the market. In other words, this is a feedback effect. We believe it's a novel feedback effect from machine learning that we are one of the first to study that may affect corporate decisions. Now, companies may actually this fit into the more general literature about regulation and like regulatory arbitrage, and as well as like reverse engineering in machine learning, right? When you have a machine learning rule set, then people can reverse engineer your rule and modify their decisions or behavior so that they can get favorable treatment. This is called a strategic classification in the machine learning theory. This is also related to some recent study about the need to have a manipulation-proof machine learning algorithms, because in anticipation of such effort by the agents, we need to design machine learning algorithm to be better to filter out such behavior. So this will be future studies topics as well. Now, let me quickly describe our data sample. So most of the data, typical data like words and 10K and 10Q filings from SEC Edgar. And we also have the SEC log file data, which basically track all the requests and download of all SEC filings with IP addresses. So this is can help us to obtain the machine download data. And finally, we have a conference call data of over 2010 and 2016. One of the key variables in our study is machine download. We define machine download to be an IP address downloading more than 50 unique foreign filings on a given day. This is following the definition in our prior literature by Lima and Wang. All remaining requests will be classified as other requests. Now, if you aggregate, now we want to understand the machine request or download prior to corporate filing, right? Because basically we don't want to have the endogeneity, like the filing actually generate request. So we compose the average machine request in the past year up to the 30 days before corporate filing. And here is the summary stat of machine download. And you can see that it's steadily growing over time. And the numbers of them reached to more than 100 million download in 2016. It's a huge number. And in terms of percentage of all download, it also steadily grow and reach like 80 or 90% of all download is consistent with SEC estimates. So machine download become very, very important. Who are behind those machine download? And actually, we might have some usual suspects. Hedge fund are probably the prime suspect for adopting AI technology. And we actually identify AI hedge fund using the work of our colleagues, Guo and Xi, who identify the employee AI credentials via LinkedIn. And we do find the AI hedge fund ownership is very significantly associated with machine download. So suggesting that the machine download are really related to AI and machine learning. And on the other hand, we also we can pass out the identities of the machine downloaders by their IP address. Now, some of the machine downloader actually hide their identities by using proxies such as Amazon Web Services. So the top downloader actually is Amazon Web Services, but we, after removing those, we see that the top downloaders are kind of the usual suspects like Renaissance Technologies, Two Sigma, which are very large quantitative hedge fund. And if you go down the list, you also see other hedge fund and financial conglomerate with asset management branches. Another important measure is machine readability. So how easy filing can be understood by machines. Now, from summarizing the literature, we summarize 5 important characteristics of filings that can make machine understanding more easily. For example, like how easy to separate tables from text using the text, extract numbers from text, and so on. Now, if you take the average of the standardized components and construct the machine readability measure in our paper, we find that machine readability actually increased over time from 2004 to 2010 or so. You see the sharp increase. After 2010, it's sort of stabilized a little bit because machine readability can only be increased so much, right? There's the limit how much you can increase them. Now, here are some concrete examples. Here is a filing, 10K filing by Verisat Inc. You can see that this filing is very, it's not very human friendly, right? Because we cannot understand what's going on, but it's actually very machine friendly because it has the tag for table and for row, for column and cells. It also does not refer to external exhibits. All these are machine friendly. In contrast, this is another filing that may look appealing to humans, but it's actually not machine friendly because the tables and numbers here are presented not in like a formatted way, so that machines may have a hard time extracting the information. And also this filing also refers to other files not in this file, which can cause more problems. Now, our first test showed that so studies how machine download from the past can affect machine readability of the filing of the company in the future. So the first two columns show that if a company is downloaded by more machines, then significantly the company will increase machine readability. So that's a very significant relation. And this also holds if we use a percentage of machine download or use the alternative definition of machine download by Laura and McDonald 2017. We can also use the principal component of machine readability rather than average. You have the similar result. And if you separate the 5 components of machine readability, and you see the result also hold for each component. So it's pretty robust. Now, that's a relation between the machine download and machine readability. And one might also wonder how firms actually actively change their machine readability. So here we actually look at machine readability upgrade. So if we observe a company change their machine readability by more than 1 standard deviation change in the variable in a given firm year, then we call it a machine readability upgrade. And we see that machine download actually predict the future machine MR upgrade, as well as the first MR upgrade. And all these results also hold after controlling for company fixed result and a year fixed result, meaning that these actually reveals the relation between like time series variations within the same company, right? Machine download can drive changes in machine readability. What are the impact on information dissemination in the financial market? If the company increase machine readability, does it have implications in the financial market? So to study that, we first look at the speed of trade after a filing. So we have 2 variables: time to the first trade, which is the number of seconds between the filing of the IDGAR on the IDGAR and the first trade of the issuer stock after the filing. And similarly, time to the first directional trade is the trade that have the same direction as the price 15 minutes afterwards. So which means the trade that's in the correct direction. And for both variables, we find a machine download. The higher machine download actually predict lower time to the first trade and first directional trade, meaning that firms actually trade much faster if the machine download is higher, which is intuitive because machines can process faster. And the interaction between machine download and machine readability implies that if the filing is more machine readable, and this effect is actually even stronger because machines can have a easier time processing those filings. Now, how about liquidity, right? Does it have impact on beta spread or liquidity? We find that machine download actually, higher machine download actually implies a higher beta spread or lower liquidity. The reason is that in the market, there can be different classes of traders. So machine capable traders would have a better advantage, as we already show, they can trade faster. However, that can increase the information asymmetry between them and other traders. As a result, the beta spread actually can increase. Now, let me look at the next major finding we want to present. We want to study how managers actually change the content or the sentiment in their filings. For this purpose, we use 2 commonly used dictionaries in the text analysis. One dictionary is Harvard dictionary that's used in many papers. This paper, this dictionary classifies positive and negative words and based on, and has been known for many years. But more recently, in 2011, Langlois and McDonald come up with a specialized dictionary of positive and negative and other tone words that fits the context of financial situations. And so far, this LM study has received a lot of attention and has been cited more than 5,000 times and has been widely used in academic studies to measure the tones and sentiment of disclosures and news and so on. In addition, the industry has adopted from our conversation with industry people. It's also widely adopted. So we think this is a good proxy to measure the introduction of a new technology into the market. And we want to watch how the managers respond to such new technology. Now, the sentiment here is defined as a representation of negative word in the document because as is well known, positive words do not have much impact because managers can have a tendency to use positive words in their document, so they don't carry a lot of information as shown in prior studies. And we also try to compare the sentiment measured by LM, Lawrence and McDonough dictionary and Harvard dictionary, because they should have different implications because LM is a more recent specialized dictionary, more used by machines. And our results show that after the publication of Lawrence and McDonough in 2011, managers actually actively reduce the use of LM negative words, right, as shown in the first two columns. Especially when their findings are downloaded more by machines. In contrast, you don't see such pattern for Harvard sentiment. So this is a very nice placebo test, right? Because the Harvard dictionary is also used before LM, but you don't see the similar trend for that. And the difference between them also is very significant. So it's a different diff test shows that the event of publication of LM does drive the reduction in negative words. And we also study which words are more reduced more in this table, basically. Some words like restructuring, termination, restatement, decline are substantially reduced in use after the publication. And this figure actually shows that there are kind of parallel trend in the use of negative words for high machine download firms and the low machine download firms. So the red line is a high machine download firm, blue line is a low machine download firm. So the usage of LM negative word is similar before 2011, but after 2011, there's a clear divergence between the use of negative word for these two groups of companies. So it's a nice natural experiment in this setting. LM also introduced other tonal words in addition to positive and negative words. For example, litigious words such as claimant and tort can indicate the firm is in a more litigious environment. Uncertain words means uncertainty. Weak model and strong model words actually indicate how confident the manager is about the statement. Weak model means possibly, could. Strong model means really confident, always and must. And each of these categories, as shown by LM, can predict one or more negative outcomes for the company. And we want to also study whether managers avoid these words as well after the dictionary become publicly known, right? Because we want to show that we are not cherry picking the dictionary. LM actually published many dictionaries in addition to positive and negative words. And we do show that, we do find that actually the companies with more machine download actually reduce the use of such words, such with a negative implication, but they are may not be negative themselves, including litigious, uncertainty, weak and strong model words. So that again confirms that the publication of the LM dictionary served as an instrument to the modification of the sentiment in corporate filings. Our final test is involved another context, another dimension, the vocal dimension, in addition to the textual dimension we studied before. Starting around 2008, actually voice analytic software such as LVA has become popular. And even for companies, some companies actually use this software to analyze their CEO's speech. And some prior studies like Mayo and Vanderkachalam and Hu and Ma actually use the vocal expression of the manager to study the implication on financial market. Now we won't study whether there's a feedback effect of this availability of such software and technology on how many years talk. So first of all, we construct a sample of conference call speeches from unique companies. And from the speeches, we extract two key measures of emotions, which is valence and arousal, which correspond to positivity of the speech and excitedness of tones. These features can be extracted using machine learning software, which is available. It's available from a computer science paper. We just use the updated version of this software to extract the emotional features. And both features are bounded between -1 and 1. Now, what do we find? There are more refined versions of the emotions, like 8 possible emotions. But in our study, we only focus on the 2 dimensions to make it simpler. Now, what we find is that companies with more machine download or AI readership tend to increase the positivity of their emotions, CEO's speech emotions. On the other hand, to a lesser extent, they will increase the excitedness of their tones. This also is intuitive because CEOs want to sound positive, but they may not want to sound too excited because they want to have a stature or posture in their conference calls. So finally, to sum up, this paper studies how companies respond to the rise of machines in the financial market, right? Because corporate filings are increasingly being read and processed by machines and AIs, companies will cater to them in several ways. First, they make their filings more machine friendly. Second, they adapt the sentiment and other tones in their corporate filings. And finally, they actually adjust their vocal patterns in response to machines. We believe that our study is one of the first to study this feedback effect of machine learning into corporate decisions. We hope this is actually a simple study. We hope this is the first step for future studies, because as the machine become more and more important in the future financial market, such behavior and strategic interaction between machine and humans may become more important. Thank you.
All right, thank you so much. So the discussant is Augustin Landier.
Okay, so thanks. So it's a pleasure to discuss this paper. So but the context, it's this rise in automatized information processing in asset management. So clearly there is much, faster processing of information. Many quant funds trade signals based on non-structured data using NLP. And so what this paper tries to test is the idea that firms have been adapting themselves to, the treatment of the information they produce, and that they might be strategic, trying to manipulate or at least to be self-serving in a sense in the manner that they produce information. So what I will do, I will first summarize what the paper does, and I think the paper has 4 main results that I will summarize. Then I will give some ideas about what it could do even better. And then about, where is this going in a sense, what is the equilibrium of this sort of, like feedback loop? I mean, clearly the next generation of quant signals cannot be sort of naive about this kind of feedback effect. And so in a sense, what is the fixed point of this feedback loop? Okay. So in a sense, in the background of all this, so this is the chain of production that we are looking at. So we have companies that produce information that gets interpreted by investors who decide how to trade based on that information, and that feeds back into prices, which might affect companies, or at least companies might be concerned about their prices. And so the paper basically is based on the idea that nowadays they are, like a mix of quant investors and more qualitative investors. Among the quant investors, when you give them text, they are not going to read it with their eyes, but they are going to analyze it with algos and trade based on, how algos interpret this text. And so the paper tries to exploit the idea that, if there are many quant investors listening to a given company, that company might be strategic about it, try to disclose information in a manner that is going to lead to more sympathetic trading towards the company. So ideally, the ideal setup to study an effect like this would be a diff in diff setup where, you will have some kind of exogenous shock attracting screening of a group of companies by quant investors. Then you will have a control group that is unaffected, and then you will ask yourself, oh, is the group of traded companies changing the way they communicate to the market? And so that's a case where that ideal setting is not present. So what the paper does is it says, look, we don't have an exogenous shifter of quant attention towards companies, but we observe the recent level of attention by quant investors through this variable called machine downloads, which basically counts the number of downloads by quant funds of the filings, the SEC filings of a given company. Okay, so basically what it assumes is that, the variation, the cross-sectional and time series variations in this variable are going to give us a proxy for, how concerned a company should be about what quant investor will think about it, and therefore the incentives it has to manipulate information. And so this variable machine downloads, so actually it's quite remarkable how well it can be mapped, it can be traced back to large quant funds like Renaissance, etc., for their IP address. So that's quite convincing. And so let me sum up the four main results of the paper. So the first one is that firms are catering to machine readers through readability, in the sense that machine readability, how easy it is to process information, is strongly correlated with machine downloads. And that's true not only in the cross-section, but even in the time series. If you control for film fixed effects, the result is very strong. So result number two is that when machines listen, trading on a given piece of information is faster. Okay, so basically the time to trade vis-a-vis the publication of a given information is smaller if there are more, like machine downloads, and even more so if readability is high. Okay. So result number three tackles, in a sort of old microstructure question, which is, like if investors have sort of, more asymmetric information, that could be bad for liquidity. So basically what it looks at is whether the bid-ask spread after the publication of an information reacts more positively or more negatively, depending on whether there are more machine downloads present on that file. And so basically what it finds is that the bid-ask spread tends to increase, so suggesting that there is a kind of worsening of information asymmetry, because the market, people know that, the quants are highly informed, they have already read through machines the Wood document, whereas the more qualitative investors need time to process the information, and they will be concerned that they are at a disadvantage, and so they will avoid providing liquidity at that time. And the last result I will comment on is it's an event study, sorry, there is a typo, that basically uses, like the introduction of the Lugron-MacDonald dictionary in 2011, arguing that, it became sort of widely used, and therefore one should see companies becoming more strategic vis-a-vis that dictionary. And so indeed, you see basically companies becoming more cautious about avoiding, like words that convey negative sentiment in that dictionary in particular. Okay, and so that's really an event study approach. So my comment, so first one is on the plausibility. So I believe it's totally plausible, and I think we all know, and just can speak to people in the industry, that people do actually use NLP to process information and to try to trade rapidly on new filings based on those algos. I will actually bring a bit more perspective on this. First, using a bit more the theory, literature that is relevant for that, like all the signal jamming stuff by Holmström, etc. The Lucas critique also, because that's reminiscent of this kind of effect that, like what has happened in the past. People are going to be less naive going forward. And so I will discuss a little bit that when I speak about, where are we going in terms of equilibrium, the cheap talk literature as well, in the sense that, if everybody now is staffing their documents with positive words and avoiding negative words, well, ultimately that's going to decrease what kind of information can be learned using that. And maybe also past episodes, even prior to the AI stuff, in the governance literature, for example, I don't know if some of you guys might remember the compositiometric paper that basically constructed a rating on governance that historically in the backtest was predicting future stock performance, because historically people were not very cautious about that type of information. They were not looking, for example, at independent board members. But as soon as it became a standard, basically companies became good at camouflaging, their governance, and now every sort of large company has all the independent board members and so on that you need to have a reasonably high governance rating on this dimension. Okay. And maybe one last thing is, it's something a bit more general that you could place in the AI literature. There are many industrial uses of AI that basically are based on trying to predict the behavior of agents, and basically backtesting that, you are able to detect fraud, you are able to detect whether a restaurant is good or not based on ratings, you are trying to predict car accidents based on whether, there are a lot of pictures of people drinking in parties or not in the social media. And obviously in phase 2 of these developments are, as like insurance companies, employers, etc., start to use these ratings, agents are going to start becoming more strategic and becoming cautious, not to leave compromising traces, for example, on Facebook and so on. So anyway, so going back and narrowing down to finance. So my main comment, but as you can imagine, so it's a bit on the exogeneity of the machine downloads variable. So it's a cheap comment in the sense that it's not easy to find exogenous variation, right, for why quants might look at companies or not. But let me tell you what is my concern. My concern is that quant funds download these files in bulk, right? The marginal cost of downloading one more file is really like extremely close to zero. And these are not super large files actually, so even storing them is not costly. And so in fact, I think most quant funds that I have seen operating on this, they download all the files that are relevant for their trading universe. And sometimes even more because they perform cross-sectional comparisons as we do in academic research. And so my worry is that machine downloads might be a proxy for whether a stock is more often included among quant tradable stocks or not. So what are the ways around that? So first robustness check I would be curious about is just, what if you restrict the analysis to the sort of core universe of hedge funds, which is the top 1,000, let's say, or around that range, companies by dollar liquidity. So just compute average daily volume in dollars, rank companies in the US along that, and basically I just would be curious to see if the results are still significant within that sort of core universe of tradable stocks. Second thing is, I think you could more aggressively saturate controls, including splines of the variables, quarter year, not only year only, sorry, it's not rather than quarter, it's rather than year only, because you can still have, trends within years that can be captured because it's a short period and, clearly people are becoming more and more cautious about the language they use. Inclusion in indices. Some funds actually have a universe that is based on stocks that are traded or have been traded in an index. Use practitioners rules. So that's my first point about like looking at ranks, using average dollar ADV, for example, etc. Checking also availability to short, because most hedge funds, since they are long short, are going to only include stocks that are actually shortable. Another thing is I would like to see lags of this variable just to understand a bit better the speed of adaptation that you observe in the data. So it's nice that, like putting firm fixed effects doesn't affect the results, but still it would be interesting to see, whether basically it's really the recent lag that matters or, like whether it's kind of a slow moving change in behavior that companies adopt. So the second thing is, there might be potential instruments. So in the literature, it's not like there is no instrument for this type of setup. So there is the XBRL format that has been used in several papers, including actually one of our students, Junit Zhao, who was on the market this year. And so basically in 2009, the SEC required, like more readable format from companies on their 10K and 10Qs. And so this format was introduced in a staggered manner based on size. And so that allows for, a kind of definitive approach by discontinuity around the adoption thresholds. So that's I don't know if it's if it works or not, but that's in a sense I would like to know if it doesn't work, why it does not. So along this line of identification, I think one thing you could look at, and maybe that's a second paper, the paper is already rich, and again, these are comments on how to do even better, but ESG ratings, I think, is a really good candidate for that. I mean, you have a proliferation of ESG ratings using NLP analysis, including the most commonly used, the MSCI, Bloomberg, etc., claim that they analyze text and they are looking for like whether the word diversity occurs enough, etc. And so basically that's a case that is interesting for identification, because you could use discontinuity around thresholds, looking at companies that try to climb up in the chain of ESG ratings. And that sort of also gives an angle that is a bit orthogonal to the quant versus non-quant investors. Okay, so let me move on. So comment number 2 is why and when are companies trying to cater to the quants? When are they trying to look, like better to the quants, maybe at the cost actually of looking less attractive for the non-quant investors? And so here, I mean, a little bit of thinking of, what are companies trying to achieve? Because the best they can achieve is maybe, a temporary boost in stock prices. So if that's the case, one would expect manipulation to be stronger when companies are about to issue equity or before insiders are about to sell their stock. Stuff like that would be quite convincing, and basically all the manipulation literature going back to accruals and so on is looking at this kind of strategic behavior. The other thing is that, okay, thank you, Hugues, 5 minutes. So sometimes it might be optimal to decrease readability to be more opaque, such as to decrease, how strongly the quants might react, especially when you have bad news to announce. And so I was trying to think about, given that this readability, sometimes you can push back, in a sense, the quants, given that you have shown that there is this negative liquidity effect of the quants being able to read too fast. It might be that, sometimes, or for some companies, it's actually preferable to push back the quants and make things more opaque. And so here, yeah, some thinking about, when do you want to manipulate and in what direction, basically, that would be interesting. So comment number 3 is, bringing a bit of perspective on where is this going. So it's kind of a variation tatonement, whereby we have this partial equilibrium, things go, the pendulum goes in one direction, and therefore you have this feedback effect, which creates, perverse effects in a sense of, people being able to process information automatically. But then clearly, there needs to be a fixed point. And so I don't know where the equilibrium is going, but basically, quant strategies based on naive NLP, maybe they performed initially and they had good backtests, but then probably large amounts were allocated to them. Plus, that gave incentives for companies to manipulate. So at some point, performance on these naive signals becomes lower. There is an aging of these signals. So there will be less capital allocated to them. And so at some point, basically people will move either to more sophisticated NLP. There might even be, some kind of negative thing whereby if you manipulate your text, it means that you have something to hide. So in fact, the signal could become even the opposite, whereby, people who use naive manipulation might be, you might trade against them because that means there is something fishy going on. And so where is this going? So what is the equilibrium? Is it more heterogeneous tools among the quants? Is it a new generation of tools? But anyway, that would be interesting to have a perspective a bit on this. So let me conclude. So it's a very exciting paper. It's clearly, like talking about something that is real and at the technology frontier. And so it's both provocative, I would say, and highly realistic, which is a rare combination in a sense. Ideally, you could step up a bit the identification, either through a regular instrument or by buttressing a bit the saturating the set of controls that you put. I mean, there is a lot of space for that. The results are very significant. So as a reader, one wants to know, up to what point you can push the result by saturating the space of controls. And then, maybe you opening with some thoughts about what kind of equilibrium can we expect? Do we already see traces of people using generation 2 tools in a sense of NLP and moving away from the naive signals? But thanks a lot. That was a pleasure to read the paper, and I give back the floor to Hugues.
Right. Thank you, Augustin. So Baozhong, would you like to take a few minutes to respond?
Yes. Thank you a lot, Augustin. It's a very insightful and helpful comments. A very good summary of the paper as well. Thanks a lot. Yeah, I think the comments all make a lot of sense. So your comments about identification and saturating controls and natural experiment are well taken. And I think we can definitely adopt these suggestions in our revision of the paper. Your comment about ESG ratings using NLP, I think that's a very nice one and could well be the next paper, right? It's a very nice citing and it's very conceivable that companies have been doing this ESG manipulation and given the importance of these ratings nowadays. You also made a lot of suggestions about when to cater and which direction to cater. I think, yeah, those are also great comments. We definitely want to implement some of them. One comment I have about the direction of adjustment is that we observe machine readability typically is one direction adjustment. So because after it's kind of like a system upgrade. After you upgraded your system, it's less likely that you can downgrade it in the future, right? Because it's a but we can look into that whether that does happen. So that that's at least according to our observation, it's more likely to be permanent. I mean, sort of permanent upgrade. And finally, your comment about long run equilibrium, right? That's a very important one because we are also interested in learning that. Actually, after our paper came out, it was covered by many newspapers and magazines, and some companies and their investor relations department actually call us to learn more about what to do in this environment. So I believe in the future, they also want to know what kind of tools AI readers might have, and they want to be equipped as well. So so it's probably going to be an arms race in the future, right? Because once you have the
it creates a new endogeneity problem, right? If companies ask you what they should do, it means the next paper will have new endogeneity issues.
That's true. That's
great. And again, totally realistic paper. I mean, I think it's totally not science fiction. I think you are totally right on point with what is going on right now in the way companies try to communicate with the market. So definitely.
Yeah. Thanks so much. Yeah.
Thank you. So any questions from the audience?
Hugues?
Yeah, please go ahead.
Yeah, I would like the authors to perhaps address Augustin's comment on the company's objective function. So why would they like to get more attention from the quants, from the quant funds?
Yeah, I think when we talk to companies, their investor relations department, it seems that companies actually do care about their shareholder base. They track who are their shareholders and what their identities. So it seems that if they know that more and more firms are using AI and machine learning to process their corporate filings, they should care about the sentiment those companies read off their corporate filings, right? That's a natural explanation from our side for that.
Thanks.
Okay, any other questions? You can raise your hand, just speak up, turn on your mic, or write it in the chat window. Okay, so let me remind you that we'll create some breakout rooms, so one for each paper that will be opened for 45 minutes. So you can move across rooms, right? Discuss with the presenters and the discussants if they are available, of course. So we have a question from Anna. Please go ahead.
Yeah, thank you. A great paper. I really enjoyed and learned a lot. So we are here consumers of all this machine learning. You are the producers. So that's why I wanted to get your sense about which algorithms are in now. For example, contextual learning, everybody talks about it, you know, word to vec, BERT, and all that. Is this really replacing the bag of words algorithms like dictionary based? Or like, where do we stand on that? So this is nothing about your paper, it's just curiosity. Thank you.
Yeah, thanks a lot. Yeah, some of my co-authors are here, but let me take a lead first. I think indeed you observe the trend of like more advanced like ARMs, right? Like BERT or more recently GPT-3 by OpenAI. These have amazing performance, sometimes even better than humans in understanding text. We believe some companies are already using that, right, from anecdotal evidence. So there are also some finance papers using BERT. Actually, our co-author Zhang has a paper using BERT to extract information from mutual fund disclosure. So definitely this movement is going on, and but one issue with all the new machine learning algorithm is that it may be harder to explain, right? So there's a trade-off between performance and interpretability. If you can find a good way to interpret the new models, right, to find a new insight. I think Alan did something in his paper, but he can probably talk more about that. But basically, as financial researchers, we want to understand the insight. So the dictionary-based approach is more intuitive. So it has been very intuitive and favored by researchers. But going forward, I don't know. I don't want to predict, but we probably will see more and more advanced approach, right? As long as we can interpret them.
Thank you.
Thanks.
Okay, so before we break out into different rooms, let me thank all the presenters and the discussants for today. And I'm looking forward to seeing you again tomorrow.